The management now joins us. Partha D. Sarkar, Chief Executive Officer of Hinduja Global. He joins us live from Bangalore. Mr. Sarkar, good morning. Thank you for joining us. I'm curious to understand the details of the detail where some marquee investors have invested in your company. Was that open market transaction or promoter company sold out to some marquee investors?
No, I think the promoter company's holdings have not changed at all.
What Mr. Jhunjhunwala and his friends invested in two days ago was a pure open market transaction. It's got nothing to do with the management of the company.
No.
Okay. After that clarification, let's talk about the business environment. First, characterize the big picture for us, then we'll get into specifics.
I think the markets, I'm really bullish on this industry because I think the market is huge. Depending upon whether you're talking to Gartner or you're talking to IDC, it's in several hundreds of $billions. And it's a fairly fragmented market. If you look at it, in that kind of a size of a market, firms who have a turnover above $1 billion is less than 10. Which means for mid-sized players like us, there's enough opportunities and no one or two big guys are cornering the entire market. So which is very good. And the CAGR for the next 5 years also looked at about 5% on a base of about, let's say, 200 billion. So I'm very bullish about the industry. If you see, it's reflected in our results as well. We've grown phenomenally in the last 2 years, in excess of 20% each year. So we've virtually doubled the company from 1,000 crore to 2,000 crore in the last 2 years. And where we stand today, we're also bullish upon what kind of growth that we'll see today, this year. So very bullish about the industry and the sector.
Mr. Sarkar, give us a sense of your geographic revenue mix and how is volume growth really going to be like in key markets? What is it that you're expecting in terms of volumes as well as revenues in all your geographies for the second half of FY14?
So our revenue mix is predominantly from North America. That is a mixture of Canada and US. US about 57% of our revenues, Canada about 20% of our revenues. UK is smaller, it's about 12%, and we have a very small presence in the India domestic sector, that's at about 8%. Our volume growth would typically end up being in the high teens, so let's say 15-16% of the 20% plus growth that I talked about. That's the kind of outlook that we have for this for the remainder of the year.
There's a buzz in the market that Hinduja Global is scouting for a big acquisition in mainland Europe. Is that true?
Well, we've been acquiring companies. We've had 8 acquisitions in the last 10 years. So I won't be able to comment about that buzz because I have not heard it. Right now, we're not looking at anything in the Europe.
Your stock also has a very strong dividend yield of about 6% plus. The management historically has given or has rewarded shareholders by a strong dividend payout ratio. Now that your profitability is going to improve by 20% like you projected, will your dividend payout also increase?
That's really the board's prerogative. What we have done is, even though in the last couple of years we've had some profitability challenges, we've kept the dividend payout at the 200% number. So, in fact, profitability will improve. So, I would hate to comment on we don't have a published dividend policy. We have a dividend track record, which has been 200% for the last 4 years. And the profitability is on track. So, that's where we are. I don't think I'll be able to go beyond that and give you an indication as to what dividends are going to be likely to be.
You just mentioned that you're not looking at any acquisition in Europe. What about other geographies? You just talked about your chunk of the revenue coming in from North America. Would that be something where you could be interested in?
Our acquisitions are done. We've done 8 in the last 10 years. And that's set up a platform which is going to give us organic growth going forward. So if you were to look at acquisitions now, those would be in areas that we are not present today. So this could be new markets, this could be new delivery destinations, or it could be new capabilities or competencies that we don't have. Those would be in niche areas, and in niche markets. I mean, acquisitions is something that we continue to look for. I would just say this much, that the big ones are already behind us and they are very well integrated and they've set up a good platform for us. That's where we are today.
But at top line, your company is growing. But if I look at the margin trajectory, margins have really fallen off the cliff from 17% to sub 12%. Because of the rupee tailwind, where will your margins finally settle? Can they go back to your peak levels of 17-18%?
Okay, so that's a very interesting question that I have been defending for a long time now. So it's familiar territory for me. What had happened to our profitability in the last 2 years was our exposure to the India domestic market. And large part of our losses came from that. What we've done as a result of that, we've really reduced the exposure to the India domestic market. We've downsized the business. We've exited from client relationships we were not profitable. So what you're seeing right now is a correction that's happening as a result of the portfolio change. On an ongoing basis, we do believe that we are going to lie low in the India domestic space and focus more on our overseas businesses. And therefore, the profitability graph that you're seeing right now is on the mend and is going to improve, is what our belief is. We expect to improve it to the mid-teens at the minimum. Whether we can go back to 17-18%, that's probably a steep one. But mid-teens is something that we are very bullish that we will be able to reach. And what's also helping is that 32% of our revenues are from exports, so which is either in Indian rupee or in Philippines peso. So the strength of the US dollar actually has helped us also in some part of the margin improvement. So if you look at our last quarter, the margin impact was let's say about 3-4%. Rest of it came actually through organic growth and through better capacity utilization and all of that.